Good day, ladies and gentlemen, and welcome to the Whittier Trust Actionable Ideas Conference Call. At this time, all participants are in a listen-only mode. The presenter will answer questions at the end of the presentation. I would now like to turn the call over to Sandeep Bhagat, Whittier Trust Chief Investment Officer. Sir, you may begin.
Thanks, Kat, and good morning to all of you. It is great to reconnect with all of you. It almost feels like I last saw you in a different lifetime. So much has changed in the last 5 months that all I can say is what a decade this year has been. And it shows no signs of slowing down. So the fallout from the coronavirus pandemic continues to mount. It has infected more than 15 million people in over 200 different countries. And along the way, it delivered the single biggest shock that the world has ever seen. And yet, stocks are up significantly from their March lows. They're up by more than 40%. In fact, they're in positive territory for the year and within a near 4% of their pre-crisis all-time high. It's hard to believe given what has happened in the last 5 months. Now, on one hand, there are good reasons for the strength in the stock market. Policy responses have been timely, they've been aggressive, and progress on the medical front has been remarkably swift. On the other hand, however, there is a lot of negative headline news. The virus is still circulating. More than 16 million people are still collecting unemployment checks. Bankruptcies are growing, job losses are mounting, and at the same time, we have political discord, income inequality, civil unrest. All of those seem to be on the rise. So where exactly are we? Are we in a recession or are we in a recovery? At times it feels like we are in both, and how can that possibly be? So let me try to answer this specific question in the next few minutes. I have some takeaways by way of a summary at the end. So for right now, just sit back and listen to this like you might to a story. So give me a couple of minutes to quickly get us caught up with how we got here. So here's our journey. So back in March, it was remarkable how quickly a handful of sectors were immediately affected by the coronavirus pandemic. Let me go in clockwise fashion from the top left. We saw hotel occupancy drop from 70% all the way down to 20%. Global flights declined by 60%, and peak rush hour traffic in major cities fell by 30 to 40%. But what about the broader economy? What happened there? And here we turn to the Purchasing Managers Index. It's a common gauge of economic activity. A PMI level of more than 50 suggests expansion. PMIs dropped below 45 during a recession. Well, we fell way below that threshold. As early as April, PMIs in the U.S. were significantly into recessionary territory. Manufacturing PMI fell down to 36, services even lower at 26. And how did it look elsewhere in the world? Well, Europe fared even worse. Here are their numbers from back in April. Manufacturing PMI was 33 and services fell to a scarcely believable level of 12. And then what happened along the way? We learned that the only way to combat the virus was through social distancing and shutdowns. And this immediately took a toll on the labor market here in the U.S. You can see that the previous high for weekly unemployment claims was registered during the global financial crisis. It was a mere level of about 700,000 claims. This time around, we exceeded that number by an order of magnitude. Unemployment claims spiked and they peaked at 7 million back in March. So this type of initial devastation raised the worst fears in minds of investors about a deep and a protracted recession. And so it was no surprise that markets followed suit. It took a mere 6 days to produce the fastest bear market in history. In fact, the S&P 500 declined by 34%. In mere 23 trading days as well. And then something strange and remarkable happened. There were significant policy responses, and this gave investors hope that a credit crisis could be averted, and it led to a rebound in the market, literally from the day that we registered the low. And what kind of rebound did we see? It was spectacular. We saw a 50-day return of 40 percentage points. How does that stack up historically? Well, it's the best 50-day return since 1933. Let me collapse all of this price action into a more conventional price chart, and I will let you look at this picture. And in the meantime, I'm going to pose a couple of questions just for introspection. So, how many of you expected to see something like this back in March? How many of you are trying to come to grips with the remarkable rally that we have already seen? And then how many of you feel that prices have moved too far, too quickly, the stock market is ahead of itself, and valuations are too high? Well, this is precisely the topic that we will focus on. And I'm going to reframe this question by posing another binary question. Is the stock market today, is it disconnecting from today's reality? Or could it be that it is simply reconnecting to some likely future state of a new reality? And we're going to address this dichotomy along the continuum of time. So let me break time down into two states, the present and the future. So we know the stock market's discounting mechanism makes it look ahead. It is future views that get incorporated into today's prices. So it really is fair to say that stock prices are generally more connected to the perception of future reality than they are to the reality of the current state itself. Investors know this. They are mindful of this observation. And yet, this time around, the big struggle for investors is how do you wrap your head around the fact that at any stage, the future is likely to be considerably different than the present or the past. Very few times have investors been asked to focus on such dramatic differences. So the coronavirus pandemic has brought uncertainty with it every step of the way. Right from its onset, investors have no clue about what the future might look like and how different it might be than the present. And it is for this very reason that there has been some confusion in investors' mind. So allow me to bring this together. I am going to suggest that this divide between the present and the future lies at the heart of a disconnect between the real economy and the stock market. Main Street is reflecting the current pain from the continued fallout of the pandemic recession. Wall Street, on the other hand, is looking ahead to a likely recovery that may heal the global economies going forward. Now, how defensible or valid is Wall Street's optimism? We think there is some merit in those views, and it really comes down to three potential catalysts that could make the future better than the present. We have significant monetary and fiscal stimulus, and as a result, ample liquidity. Progress on the medical front has been swift and rapid, which leads to some hope that we can control the virus. And this recession was created by an exogenous shock, which curiously has some implications for the recovery ahead. Let's look at these factors in quick detail. I'll start on the liquidity front, specifically with monetary policy, which brings us to the Fed. And the response from the Fed has been truly remarkable. What have they done so far? Not only have they ensured the smooth functioning of markets, they've actually delivered credit into the real economy. So what have their steps been? Very quickly, in one short week, they cut rates all the way down to zero. And then they embarked on yet another round of quantitative easing, QE. What is that? It's simply a program to purchase assets. So what has the Fed been up to? They're buying as many bonds as they can to make sure that long-term interest rates remain low. This program of QE is different than any other one in the past. Why? Because the Fed has come out and said that it will be unlimited in nature. The Fed will do whatever it takes. You can see that on the right. The Fed balance sheet has already gone up by $3 trillion, from $4 trillion to $7 trillion. It's likely to go up by an additional trillion by the end of this year alone. Now, the Fed also had a playbook from the last crisis. During the global financial crisis, they had undertaken a number of steps. So let me do a quick comparison on what is admittedly a busy chart, but let me kind of draw your attention to the highlights. So what's similar, what's different? Just like last time, the Fed cut rates all the way down to zero. Just like last time, they created lending facilities for primary dealers, commercial paper, money market funds, asset-backed securities. Unlike last time, this time around, they have extended their asset purchases to corporate bonds, high-yield ETFs, and they've extended their lending facilities to municipalities and small businesses. So in the early going so far, they've already done more QE in 1 month than they did in 3 months, 1.8 trillion versus 1.3. By the end of this year, they would have expanded their balance sheet by 4 trillion. Again, by contrast, during the GFC, they implemented QE to the tune of 4 trillion, but over 6 years at that point. Now, the Fed is not alone in its responses. Global central banks have also followed suit. You see on the left here, global short rates have fallen by almost 100 basis points since the onset of the pandemic. This has happened through 200 different central bank rate cuts, and they have also engaged in QE and extending lending facilities. You see on the right here that the extent of their QE is well over $3 trillion. Well, central banks haven't acted in isolation. Governments have stepped up to do their own share by way of fiscal stimulus. And so here in the U.S., we have seen 4 fiscal stimulus packages so far. The biggest and most significant was the third of these 4 programs, called the CARES Act, implemented back in March. The CARES Act was broad, it was comprehensive, it had something in it for almost everyone. You had one-time stimulus checks, and at the other end of the spectrum, there was small business relief. That stimulus has since grown to $3 trillion, but how should we think about the magnitude of this policy action? Well, at nearly $2.4 trillion, the CARES Act was nearly 12% of U.S. GDP. That is a significant dose of stimulus. And again, the U.S. has not been alone here. Germany's fiscal stimulus has been actually closer to 20%, more than 20%, bigger in percentage terms than what the U.S. has done. Has all of this fiscal stimulus worked so far? I think so. And here's a quick example of how that might have flowed through the system. So look, consumer spending has grown in tandem with the implementation of fiscal stimulus. How did this all work out? The CARES Act was signed on March 27th. On April 15, the direct relief payments, the $1,200 stimulus checks, started to get mailed. And so you can see here, it comes as no surprise that consumer spending also bottomed right at April 15, and it has been steadily climbing since then. So how do we summarize the effect of liquidity? We do it in this manner. We know that the Policy responses have softened the damage from the pandemic so far. We know that monetary policy can actually work on a lagged basis by as much as 1 or 2 years. So liquidity has not only been supportive of economies and markets so far, it has the potential to do that going forward as well. The second topic takes me completely out of my comfort zone, but we still need to venture into this space because it is central to our conversation. So the world's medical community has invested enormous amounts of time, effort, and resources to mitigate the impact of COVID-19. And what have they produced or delivered so far? Well, quite a bit. Let me speak to that here. Again, unconventionally, I'll start from the right and move to the left. We know the biggest medical breakthrough can come in the form of a vaccine. And we have, more than 100 of them in development at this point. More than 30 are in human trials at this point. The developments here come so thick and fast, it's hard to keep track of them. On a more notable level, here are a couple of observations. Moderna is already in phase 3 trials, which, by the way, actually began yesterday with 30,000 participants. Pfizer and BioNTech have already received a $2 billion order from the U.S. government for their vaccines. This is before they have even been developed. AstraZeneca and Oxford University claim to be on track for their early promise of a vaccine by year end. So a lot of good stuff going on here. And away from vaccines, there is still research on treatments. How do you mitigate the impact of COVID-19? And so this makes us discuss or talk about antiviral drugs. These are drugs that inhibit the replication of the virus. Gilead Sciences has an antiviral drug that has already received FDA approval. You have antibody drugs that can actually fight the infection. Regeneron is a significant company here. This is the company that produced antibody drugs for Ebola and MERS, and they already have trials for their antibody drugs for COVID-19. And away from vaccines and treatments, you can always fall back on diagnostics, where one day, if we have enough testing at scale, we can engage in the tried and trusted method of test, trace, isolate, and contain. Will any of this work out? Well, you've heard my views on this before. No medical expert, but I am bullish on human ingenuity. So, yeah, we actually share some of the optimism on the medical front. And this is not based on any grand expectation that miraculously we will get a safe, effective, durable, scalable vaccine in just a few months. No. This optimism is derived from two sources. One, medical innovation will continue to simply mitigate the impact of COVID, to reduce the risk of death going forward. And two, there is human resilience and adaptability that I hope will allow us to deal with the virus, both in our personal life and in business. An approach that we can embrace that achieves safety and that does not require additional shutdowns. So on the medical front, the hope is that progress can make COVID-19 less severe, which in turn allows us to avoid future shutdowns. Now, what is this next topic? It sounds so cryptic and so esoteric. What do we mean by an exogenous shock? And to put this in context, I need to quickly go through the life cycle of a typical recession. So most of the time, recessions are caused by endogenous, internal imbalances. They build up over time until they can no longer be sustained. This could be something like too much leverage or a housing bubble that eventually bursts. The roots of most recessions are systemic, they're pervasive, they're long-lasting. The deeper the recession, the longer it lasts. And most of the time, you have no visibility in the middle of the recession as to when it will end or when a recovery will begin. This recession is different. It was not caused by endogenous imbalances. This was created by an exogenous shock to an otherwise healthy economy. The decision to shut down was deliberate. It was made in response to public health considerations. And so we know the recession started because of the virus, and so therefore it stands to reason that it will also end with the virus. What about the virus could give us hope? I think the one key milestone becomes, can we control the impact of the virus before it can do too much harm? And so if policy and medicine can negate, it can offset, it can neutralize the impact of the virus, there may be light at the end of the tunnel, and this perspective gives us greater visibility for how all this could come to an end. So our takeaway is going to be greater visibility. And if there was any truth that the recovery could potentially be short-lived because of this exogenous nature of the shock, let's quickly put that idea to test, because we have seen a bunch of reopenings and restarts to U.S. businesses. How are they playing out so far? And I'm going to go through this in rapid-fire fashion. So first, 4 things to look at here. Again, I'll use my clockwise pattern, starting at the top left. What has happened since states have reopened in May? More people are leaving their homes. More people are dining out at restaurants. More people are getting on domestic flights, and U.S. foot traffic has increased significantly. Has this had any impact on the labor market? I think so. So look, employment dropped precipitously during March and April, but by the same token, May and June have seen a rebound. Non-farm payrolls have grown in the last 2 months. 7.5 million new jobs have been added in those 2 months. Continuing unemployment claims peaked at 25 million. Today they stand at 16 million. They have declined in the last several weeks. And whatever happened to those purchasing managers' index numbers? Remember, this is our most reliable gauge of activity in any domestic economy. Well, they have all rebounded as well. In the U.S., through June, PMI levels were back at pre-crisis levels of activity. In fact, for the U.S. and Europe, here is an additional data point. The preliminary numbers for July are even more promising. Most of these PMI numbers are now above 50. China has seen a similar story, even a quicker rebound, and their services PMI is actually significantly above pre-crisis levels. And I've saved the most remarkable picture for last. I'm going to put this up, let you take a look. This is what has happened to retail sales in the U.S. It is the quintessential V-shaped recovery. Retail sales dropped in March and April, and then they rebounded in May and June by about the same amount. We are back to pre-crisis levels with retail sales at about $525 billion. So, okay, maybe there are some reasons to feel optimistic, but it really can't be that simple, right? You're saying, right, this can't be the end of the story. This is too easy. It's too good to be true. How do you end a deep recession like we experienced in less than 6 months? There has to be something on the other hand, which of course I'm going to get to, much like a good politician. So there is the other hand, and let me suggest the following. So yeah, we see merit in those signs of optimism, but we also believe that the road to recovery will be bumpy. The path is still uncertain. You have a lot of outcomes that could yet unfold. We know there are risks, they are known risks, but they're by way of known unknowns. So very quickly, let me highlight some of the more significant concerns. And I'm going to begin this conversation, well, let me headline what some of these risks are. It's a partial list. So what do we have? We have something called the fiscal cliff. We'll get to that in a moment. We know bankruptcies and defaults are growing, and something curious is happening with layoffs. Layoffs are becoming more permanent, which causes risk to the economy and the recovery going forward. So let me pick up my story with the fiscal stimulus, which goes along the following lines. So first of all, let's identify what is a fiscal cliff. We're going to talk about the fiscal cliff. And the fiscal cliff simply says that there are a number of provisions in the CARES Act that are due to get terminated in the near future. And if they do not get extended in the next stimulus package, it means that a lot of the existing fiscal stimulus will drop off significantly, much like going over a cliff. So what are some examples of this? The most meaningful measure contributing to an impending fiscal cliff is the enhanced unemployment benefit. We know that was $600 per week. Well, you know what? That actually ended last week. How significant or meaningful is this? Well, that actually drove payments of $100 billion per month into households. You can imagine that without that flow of funds, how household incomes and therefore consumer spending is likely to get affected. And there are so many other things in the pipeline. What examples can I give you additionally? Passenger airlines were given $25 billion explicitly to support payroll until the end of September. Well, they are already making plans to terminate employees as early as October 1. Small businesses were given a lot of loans, which had the provision to be forgiven if they were used to support payroll for a period of 24 weeks. But beyond that period, they are then able to revert back to job losses and layoffs. And the list just goes on. There is forbearance for mortgage payments, a freeze on evictions, deferral of student loan payments. Should these come to an end before we bridge to the next fiscal stimulus, just watch out. That's a sudden withdrawal of fiscal stimulus and puts us at the risk of falling over that fiscal cliff. So let me switch gears. I mentioned bankruptcies could be growing. Yes, they are beginning to mount. Curiously, they're spreading from small businesses to larger corporations. What examples can I give you here? In retailing, you've seen Neiman Marcus and J.C. Penney announce bankruptcies. In the energy sector, we've seen big companies like Chesapeake Energy follow suit. What implications does this have? Well, banks are beginning to react to this. The 6 largest U.S. banks, just a couple of weeks ago, put aside as much as $36 billion in loan loss reserves, which is a significant amount. Before that becomes too concerning to you, let me just point out one silver lining to this dark cloud. Banks are in much better financial health during this recession. And finally, let me come back to the job front. I do have a picture to show you on this note. It turns out that during the pandemic so far, most of the early job losses were temporary in nature. However, more recently, these job losses have become permanent. So what we did here was highlight the trajectory and the pace and the speed at which job losses are becoming permanent this time around compared to the last 2 recessions. And you can see that line at the left show a much steeper decline. Layoffs are becoming more permanent at a faster speed this time around than in the last 2 recessions. It's too early to call, but it's a trend worth keeping an eye on. So let me summarize some of my causes of concerns. We talked about the fiscal cliff, permanent job losses, bankruptcies, defaults, I suggested this was a partial list. You could easily add on to this a resurgence of the virus. What else could you add on? Election uncertainty, geopolitical risks. So there is a fair host of issues that bear watching. Now, I know there are two concerns on your mind, and I am taking a peek at the time and the clock, and so I'm mindful of this trade-off. I know I have the risk of a sensory overload on one hand, but I am, in the interest of time, I will touch ever so briefly on these two topics before we get to questions. So what do we know about what has happened so far? We know that policy responses have been massive from governments and central banks, but that has significantly increased the debt burden for most economies. So here in the US, we have seen the federal debt go from 40% of GDP to 80% of GDP in the last 20 years. It's projected to go up further to 110% of GDP in the next 10 years. We mentioned earlier that the Fed is also looking to double the size of its balance sheet from 4 trillion to 8 trillion. And so the question all this begs is, how sustainable are these policies, and at what point do they unleash inflation? So how should we think about this problem? So let me get back to the basics again. We know the Fed's primary job. The Fed operates to deliver on the dual mandate of promoting maximum employment on one hand and stable prices on the other hand. And you can see that both these measures are well below their targets. On the left, you see inflation is low and declining rapidly. And on the right, you see unemployment is high right now and likely to be higher. So there are strong deflationary forces that are pushing inflation lower. High unemployment is one of them. There's something, I don't know, maybe precautionary savings are also causing inflation to fall. And so let's think about the Fed first, right? You see an inflation gap on the left and an output gap on the right. Inflation and output are both below the Fed's desired levels. Therefore, the Fed has flexibility to remain accommodative for a long time. But more importantly, that deflationary force, that recessionary force caused by high unemployment is in itself an offset to any inflationary pressures that could come from fiscal stimulus. That should pull inflation lower. And so in the near term, deflation is the major risk, not inflation. And let me just reassure you that it's unlikely that we will get blinded by runaway inflation. We will go through a number of regimes. We will go from deflation to disinflation to low inflation to target inflation before runaway inflation becomes a concern. We should get enough time and notice to react and adjust along the way. And the second concern on your mind, perhaps, relates to valuations. Aren't stocks too expensive? So what did we do here? On the left side, we're showing how the PE ratio might evolve or change over time. So first, a quick acknowledgement. If you look at a PE ratio based on trough 2020 earnings, it looks hopelessly high at 25.5 times. But what if policy and medicine combine and conspire to create a recovery in 21? If earnings are able to rebound as the market expects, so this is all based on consensus earnings forecasts, that PE based on 2021 earnings now drops lower. It becomes about 20 times. So is a forward-looking PE of 20 expensive? Well, the answer to that is historically, yes, it is. But maybe not so against a backdrop of continued growth and low interest rates. So let's put that forward PE into context. The chart on the right actually takes neither 2020 earnings or 21. Instead, it uses 12-month forward earnings. It computes a PE. It infers an earnings yield from that PE ratio. And what do we find here? That the earnings yield on the S&P 500 over the next 12 months is almost 4 percentage points higher than the 10-year bond yield. This is a classic metric to assess whether stocks are cheap or bonds are cheap. And it's clear that stocks are cheaper than bonds. And so, if the consensus forecast for 2021 does come through, stocks do not appear to be overvalued. So those are my observations and valuations. I promised you, since you didn't take notes, that there would be tangible, concise, clear takeaways. So let me quickly revisit a number of things that I have said, and what can you take away? We have ample liquidity. It has been supportive of economies and markets so far. Some of those policy measures worked on a lag basis. That support may still persist going forward. We think medical advances could make the impact of COVID-19 less severe on public health and allow us to continue business operations without major future shutdowns. And hopefully we were able to grasp this exogenous nature of the shock. I think the biggest takeaway from it is, unlike in past or previous recessions, this maybe gives us greater visibility. It gives us a milestone, something we can latch on to. And if policy and medicine can win this race against the virus, we probably do have a recovery. But it's not all smooth sailing. We talked about the fiscal cliff, permanent job losses, bankruptcies, defaults. I referred to but did not speak about geopolitical tensions, election uncertainty, the virus just continuing to overwhelm us. These might be too micro a set of issues. At a higher level, let me make some more conclusions. We do think that medical advances will help the cause and contribute to an economic recovery going forward. If the last 5 months are any example, the pace of medical progress should continue. Will that progress help global economies heal? We think so. In what manner? We expect the gains, economic and market gains, to be gradual. The gains won't come in a smooth and linear fashion. It will still be a bumpy road to recovery. Accompanying the bumpiness will be a healthy dose of market volatility. Because we have market volatility, does the market have some downside risk to it at these levels? Yes, it does, like it does at any point of time. Does it have significant downside risk where we actually retest the lows from back in March? We think that is unlikely. The present today is already better than the worst case that was being envisioned in the past. And so it's highly unlikely that we regress back there. Will medicine allow us to avoid broad lockdowns? We think so. We think they're unlikely going forward. And hopefully we gave you a perspective that debt and valuations, at least in the near term, are unlikely to become significant headwinds. So I'm going to catch my breath, pause there, see what questions you have, and I think, Kat, in order to do that, I think it's best that I turn it back to you.
Thank you so much, Sandeep. The floor is now open for questions. If you do have a question, please press star 1 on your telephone keypad at this time. If your question has been answered, you can remove yourself from the queue by pressing 1. Again, ladies and gentlemen, it's star 1. And our first question comes from Andre. Go ahead, Andre. Your line is open.
Yes, Sandeep. I'm sure you polished your crystal ball for this morning. So here's my question. When can we expect the U.S. DGP to eclipse 2019 levels?
The 2019 bogey is actually important for any metric of growth. I suspect the economic recovery is going to be slow and bumpy, and it could be until the beginning of 2022 that we see GDP levels get restored. But at this point, I want to highlight a bit of a disconnect between economic growth and earnings growth. There is a chance that earnings themselves might recover faster than GDP does. Why do I say that? I don't know if you've kind of focused on this, but even in the last 10, 15 years, the historical relationship between GDP growth and earnings growth has broken down. You can't even say we are on the cusp of the new economy. We are well into the new economy, and the dominance of technology companies that have shown how incredibly profitable they can be have caused profit margins to expand, and earnings have outstripped GDP growth relative to historical norms. So I do want to make this divergence that while GDP growth could take longer to come back to 2019 levels, I think earnings may come back to 2019 levels sooner. The market is expecting that to happen by the end of next year. 2021 earnings are coincidentally and curiously estimated at 164, which was the level from 2019.
Thank you.
Again, ladies and gentlemen, it's star 1 to ask a question on the phone.
Sandeep, actually, we have a couple of questions online that are asking about protecting portfolios from equity losses as a result of the 2020 election results. And a second one that said, what do you think happens if the Democrats win the presidency and the Senate?
Okay. Perfect. The election risk is a short-term risk. So I would strongly encourage investors to truly understand how they're thinking about risk over what time horizon. If they have enough liquidity for their short-term needs, just the passage of time beyond the election will allow these portfolios to get protected, right? Over the long term, we know equities earn a risk premium. They do outperform cash and bonds. We see nothing to suggest that the next decade for stocks is a lost cause. And so if you have the freedom and the ability and the luxury to focus on that long term and beyond the election, I might suggest that the cost of protection or insurance may not be worthwhile. But if you have a strong need for income and preservation of capital, you could think about seeking that protection. Now it's of the 6 or 9 month variety. You can dampen future losses by selling out of the money call options. That gives you a premium that helps buffer those losses. That's just a small baby step in the direction of portfolio protection. You can achieve more of it through being long a put option. The problem is by the time we wake up to the need for insurance, so has everyone else, and those options and the cost of protection has gone up. You can mitigate the cost. You can reduce the cost of such protection by simultaneously being short an out-of-the-money put option, in addition to being long a higher strike price put option. I know this immediately became incredibly jargony, but a put spread would be one way to do it. And should your unique circumstances require something like that, please do bring it up with your Whittier coverage team, and we will have a customized solution that works just right for you. And the second question was about a blue sweep. Is that right, Brandy?
Correct.
Okay, so this is a scenario that people are nervous about, and I think it centers around the possibility that the previous fiscal reform by way of tax cuts will be unwound and will be saddled with a lot higher taxes, especially since it might appear to be a way to deal with those big fiscal deficits. And we acknowledge that there is a risk. Biden has, on his campaign platform, indicated higher corporate tax rates as an example. We don't think that increase will materially lower earnings. We also point out that the composition of the S&P 500 earnings base has changed dramatically. And so, offsetting a negative impact from higher tax rates would be just greater adoption of technology, allowing more profitable companies to deliver more earnings to the aggregate, at the aggregate index level. There might be some elements of a Democratic win that actually become positives, right? We know through the last couple of years of the current administration, trade was always a nagging headache, right? The trade war with China and the uncertainty that it caused. A more centrist approach would avoid that negative or that headwind. So that's something to think about. If tax reform puts more savings and more monies into middle-income households, I would point out that extra money from tax savings for that segment will actually have a much bigger impact on the U.S. economy than if the higher income constituents were to benefit from tax cuts. And the reason is very simple. The spending patterns of high-income households do not change dramatically with the next incremental dollar of income or savings, but it can change dramatically if middle-income consumers end up with a bigger benefit from the tax reform, any redistribution effects that it might have. So here's our bottom line. We don't see the stock market being exposed to the risk of a bear market, right? We don't see big 20% declines in that scenario. We say that with humility and modesty. This is hard to handicap. It's still quite early in the cycle, but that's our view. And because of the nature of our investment philosophy, process, and approach, these are the types of risks that we think do not have a long-term sustainable impact on the markets, and we tend not to react to what we believe has the potential to be more noise than signal.
And we do have two more questions on the phone. The first one comes from Matt. Matt, your line is open.
Morning, Sandeep. First of all, thank you very much for such a thorough update. Really appreciate it. You mentioned at the end of your presentation the sustainability of total aggregate U.S. debt, and you addressed the risk of deflation versus inflation. My question is, will this increased level of debt have an effect on future U.S. economic growth? Will it rob any future economic growth? Thank you.
Matt, yes, I think so. Here's the problem with borrowing or deficit spending. Borrowing simply allows you to change the timing of your consumption. It allows you to consume now what you might have consumed later. But remember, I set this up as an either-or outcome. You can consume now or you can consume later. But you can't do both. You can't consume now and consume later, right? There is a finite limit to borrowing capacity. So I do think we have moved up future growth through the massive fiscal stimulus that we underwrote. In many ways, we had no choice but to do that. Absent that, we would have looked at a humanitarian crisis and economic devastation. So in many ways, the point is moot. You need to survive until tomorrow before you worry about the problems of tomorrow, and this is what this allowed us to do. But Matt, if I may go back to some of the comments that I made to, I believe it was Andre in the beginning, which is, don't despair. Even if future economic growth is lower, remember, earnings growth has long disconnected from the trajectory of economic growth. And so I am optimistic, especially with the dominance of tech companies, the continued penetration, acceptance, and adaptation of the new economy, that earnings from higher margins and greater productivity will still be healthy even if future economic growth is still an anemic 1.5% or 2%. In fact, just look at what happened after the global financial crisis, right? The economy wasn't on all cylinders. It wasn't raging. You didn't see 5 or 6% real GDP quarters. I think we registered the decade after the GFC, we probably grew at 1.7 or 1.8%. Why is this notable? The U.S. economy, the one number that people think of when they say, hey, what is the U.S. economy capable of growing at? This is the natural level of GDP growth. This is the speed bump below which inflation can be contained. And the answer for 100 years was 3% real GDP. We haven't achieved that. We're stuck in a subpar growth in a new normal. Post-GFC was a new normal. This is going to be a new normal. But the stock market did just fine after the GFC, and I'm optimistic that equities will be able to register those types of earnings gain, even though GDP growth will admittedly be lower because of what has happened in the last 5 months.
And we do have one last question from Jay. Jay, go ahead.
Hi, Sandeep. This is Jay Carpin. Given your somewhat constructive outlook on the economy, how should people be thinking about positioning their portfolio? And also, I realize you don't think inflation's going to take some time, but does gold have a place in a portfolio, especially with the expansion of the Fed balance sheet and fiscal deficit? Thanks.
So, Jay, I noticed, like a good politician, you squeezed in 2 questions under the banner and guise of one. But so what should you do with portfolio positioning? I think we have made an argument that despite this crisis, stocks should perform better than bonds. We have held that view for a very long time. So at Whittier, I will be the first to confess, sitting at the top of the food chain, that we did not predict or anticipate the pandemic, and neither did we alter asset allocation to guard against that. We entered 2020 with an overweight position in stocks over bonds, and we have maintained that because the outlook again for the next decade suggests that stocks are a better place to be than bonds in that binary setting. Having said that, my strong advice is to just stay disciplined. There is so much uncertainty around us. There are so many known unknowns that to heroically alter asset allocation to make a quick buck by saying prices have dropped significantly, let me increase my overweight to a much greater level, or let me sell stocks because there's a whole lot more downside. Those are extremely dangerous portfolio rebalancing moves. So if you were properly positioned with your asset allocation, which is a full exposure to equities, ideally a small to moderate overweight position, then just stay the course. This is not the time to make a quick buck. This is the time to avoid expensive mistakes, because the cost of doing something wrong is huge. Just ask anyone who may have sold on March 23rd or any time around that and the regret that they are experiencing. So that's my observation. I think also, like a somewhat respectable politician, I kind of gave you a lot of on one hand, on the second hand. What I'm saying is stay the course. Conceptually, fundamentally, intellectually, we think stocks are a better place to be than bonds. So that asset allocation would be perfectly justified if it was overweight stocks. And then your question was, well, what about the role of gold, especially since it has done so well? So the strength in gold is interesting. It's motivated by two factors. It's clearly a very reliable and safe haven, right? When you are surrounded with this much uncertainty, and I still suggested that there is a fair bit of it going forward, you really want to hide in something safe, right, where you just won't lose a lot of money. So gold has been a safe haven. And people still have mixed opinions on inflation, right? I'm suggesting that for the next year or two, it's not going to be an issue. Before it does, you'll have plenty of notice. You go from deflation to all those different regimes that I pointed out. But yet, for those who don't buy into that and who think inflation is right around the corner, gold gives them an inflation hedge, which has led to its popularity. The other thing gold might be doing is, normally if you worry about inflation, Jay, what would you do? You know, bonds go down when inflation goes up. So if you're worried about inflation going up, you should be shorting bonds. But the short bond trade has been taken away. Why? Because sitting on the other side of that trade is a dinosaur called the Fed, who will just keep buying no matter how much you short. So absent the short bond trade, gold is viewed as another hedge to inflation. I'm coming back to the same theme. I have expressed an opinion. At this point, I'm just going to make this a personal opinion that there may be a time in the next few months, especially if policy and medicine went out, where the emphasis on gold may prove to be unwarranted. But given all the uncertainty that is out there, I see no problem with having a small position there as just a hedge for, let's call it tail risk, a really bad outcome that could otherwise crater your portfolio, that would be anchored through the position in gold. I'm not a big fan of a permanent allocation to gold for a 10, 20, 30-year horizon. You can do it tactically during periods of uncertainty. We have gone through one. At some point, we think that will lift. If not in 6 or 12 months, then certainly in 18 or 24. So if you do build up that position, keep an eye in terms of when you might want to get out of it. How are we doing on time, Kat and Brandy?
Actually, Sandeep, I have one final question that came in online. And it says, as some are suggesting, is the Fed interest rate policy going to permanently remain under the influence of the Treasury's need to finance deficits?
They have become kind of curious partners in this crisis. The cost to the Treasury from issuing so many new bonds, we know will be held down because of the Fed's ability to buy them and their stated goal of doing so. I don't want to read anything too sinister into the cozy nature of this relationship at this point. I made this argument. There was a slide that says the Fed is nowhere close to delivering on its dual mandate of stable prices and full employment. Employment is high. By the way, the Fed's projection for where the unemployment rate will come down, they're projecting 5.5%. But here's the clincher. It's not at the end of 2021. They're looking at 5.5 at the end of 2022, which is above where we were and above what many believe is the natural level of full employment, which is an unemployment rate of about 4.5%. So the Fed independently, in order to do its job, is motivated to keep rates low and policy accommodative, regardless of doing so just to help the Treasury out, just to do their job. Because there is an inflation gap and an output gap, they're justified in being super and ultra accommodative. The Treasury's needs notwithstanding.
Great. Thank you, Sandeep.
Should we call it a wrap?
Yeah, there are no more questions in queue. Thank you.
Okay, so all I can do at this point is on behalf of all of my colleagues at Whittier, thank you for joining us today. If you think of any other questions that pop into your mind based on what was discussed today, feel free to reach out. Feel free to write to me directly or to anybody on your Whittier coverage team. I will do my best to answer them by email, and I can't wait to reconnect with you sometime really soon. Thanks.